welcome to the Community Voice channel. My name is Ivy too, and I'm your host today for CVC Interviews. And today we'll be talking about everyone's favorite subject, taxes. The upcoming tax year is approaching us, and to make it a bit more easy and approachable and stress-free, today we'll be talking to Chelagat Misiko, CPA of Misiko Tax Services, who also happens to be my mother. So hi and welcome. How are you feeling?
Thank you. I'm feeling good. Thank you for having me.
Great. So let's just jump right into it.
Yes.
So for everyday tax individuals, what are some 3 things that they could do to prepare for the tax season?
So to prepare for the taxes, they need to have all their tax documents together. That includes employees who have W-2s, and their W-2s are the wage and income statements. And they also have to have their what is called 1099s for people who trade in stocks for dividends. And they also need to have their 1099 NEC, which is for non-employee compensation, which is for self-employed individuals.
Okay. So what documents do people tend to forget, and does that ever delay their refund or return?
Yes. People do forget property taxes. In Connecticut, you get a credit for property tax deduction, and that is applied when you look at your town. You go to your town, and you pull up the property tax PDF document that will have the property taxes you paid for your cars in the tax year that you have chosen.
And if people forget that, does it delay their return or their refund?
It doesn't delay their return, but it does not give them the deduction that they're supposed to get. That reduces their taxable income.
So how do life changes like moving, marriage, or having a child affect your taxes? And what about like mid-year if those changes have occurred?
Okay, so for example, married individuals, you're considered, if you're newly married, you're considered married as of December 31st of the year. So then you can determine if you're filing jointly. And then the single ones do not have you can be single earlier, you don't have any dependents. And head of household, you have to have dependents who have lived with you for at least half the year. So those are the most common filing statuses with changes happening throughout the year.
And then about having a child, dependents?
Having a child as a dependent, you get a credit called the child tax credit, which is about $2,000 in 2025. And you get that credit that applies directly to your taxes, and it reduces your tax liability.
Great. So how can individuals adjust their withholdings to get a greater tax return?
So you can adjust your withholding on a form called Form W4, which is the withholding statement. And that has all the information you need to ask you if you have, if you need to have extra withholding. Usually it's recommended that you talk to your tax professional to see how much of tax withholding you can do. And that impacts your refund or whether you owe, because you don't want to owe because penalties and interest will be added to the amount you owe throughout the year. So but you can also get a refund if you withhold more than your taxes are.
So what are penalties and how can you avoid them?
So penalties are calculated as a percentage of your tax liability, and you can avoid them by paying into taxes either through federal tax withholding or estimated tax payments.
Great. So now let's talk about some small businesses, because there's a lot of business owners and running a business is a bit different than as an individual. So what should small business owners be doing year-round to best prepare for the tax season?
So they have to do their bookkeeping. So bookkeeping basically means maintaining your records, maintaining all your transactions in a software such that when your tax professional asks you for your what is called a trial balance or a profit and loss, it will give you your income and losses for the year, and that's reported on your schedule. It is called Schedule C in your income tax return for a 1040. So it is pertinent that they record all their transactions, whether it's income coming in or expenses, which is amounts paid out for insurance, cost of goods sold, payroll, all that. And another thing that they have to do is maintain payroll for their employees with the payroll provider. Some of them include Paychex or ADP. Some of those payroll providers maintain your records, and there are other small payroll providers too that maintain your payroll records, and those records will be required at the end of the year so that the tax professional can determine how much you paid for wages to your employees and how much you can deduct as far as payroll taxes are involved.
And what sort of mistakes do you see common happening with bookkeeping and expenses?
Well, misclassification of expenses. Some of the things that are misclassified, they go into two locations. One is cost of goods sold, or cost of services, which directly reduces the income statement, the income to give you gross profit. And then there are other expenses that are period expenses, and those period expenses give you your overall net profit. So misclassification of expenses is a big one. Another one is you have to pay attention to meals deduction. For 2025. You'll no longer be able to deduct meals for employees on site, but you can deduct meals with clients, up to 50% of meals with business clients, and you can also deduct up to 100% for employee social events like holiday parties.
Great. So what do business owners need to understand about quarterly estimated taxes, and why are those important?
So quarterly estimated taxes are important because the IRS penalizes those who do not pay as quarterly estimated taxes as they're supposed to. And the period dates are April 15th, June 15th, October 15th, and January 15th. Those are the 4 quarterly periods when your estimated taxes are due. And you pay that to prevent penalties from the IRS because they assume that since you're already making the income, you can start paying into, it's sort of like a withholding, but for small businesses, because they do not do payroll withholding through a payroll provider. So it kind of gives them a way to reduce, to pay into their income taxes.
And how do you advise people to estimate their quarterly taxes?
So the estimation of the quarterly taxes is a long process, and you need a tax professional to do it. The tax professional will project what your income will look like by annualizing your profit and loss. And once they annualize your profit and loss, they will know how much taxes you may owe within the current year for the next filing tax season.
So it seems like a lot of these forms are pretty important, the profit and loss, income tax. So do you think people don't utilize their forms as much as they could?
Yeah, actually, a few business owners, they do not maintain their records, and that makes them not to get deductions, because some deductions which are ignored could be really crucial in reducing their taxable income, because in the end, you want to reduce your tax liability in a legal way possible. So if you can pay attention to all your deductions, all your expenses and transactions throughout the year, and classify them into different expense groups, then you can tell how much your taxable income is going to be.
Are there certain tax credits or deductions that seem to be overlooked often by employers or business owners?
Well, tax deductions, there's what is called the qualified income tax deduction, which is 20% of taxable income, which is available to partnerships and self-employed individuals. That is overlooked because it's a big deduction, because that's 20% of your income. And a few credits that have come up recently includes no tax on tips. So tips that you get for an employee can be deducted up to $25,000 in your tax return. And if you're married filing jointly, you can deduct up to $50,000. And that's an annual deduction, and that starts in 2025. Mm-hmm. Another one is no tips on overtime, and only the portion of overtime that is not, that you get a deduction for, is the amount over the regular rate, which is if, say, for example, you have a 1.5 adjustment to your overtime, the 0.5 is the one that's being considered as being the deduction.
So you're referring to the One Big Beautiful Bill, which
Yes.
is just passed.
Yes.
And is the no tax on tips and no tax on overtime, is that just for individuals, or does it also apply to businesses?
It applies, no tax on tips applies to also self-employed individuals, not businesses, just the individuals and the employees who work in industries where it's common to get tips. For example, the restaurants, the bartenders, the servers, and so on.
So for no tax on tips, no tax on overtime, how can individuals best prepare their taxes for this, because this is new?
So because it is new, make sure you're reporting all your tips to get the credit. Unreported tips cannot get a deduction. And then for overtime, it hasn't been established yet how that's going to be reported. But if you have your payroll stub, your final payroll stub of the year, it will probably provide you with more information. And if you want, you can talk to your employer or payroll provider to provide that information separately in your payroll statement.
So from a CPA's perspective, what do you think taxpayers should understand about the One Big Beautiful Bill?
So the One Big Beautiful Bill was enacted on July 4th, 2025, and it brought a lot of credits. And one of the credits I want to highlight is the credit for seniors. So the deduction is $6,000. And if you're married filing jointly, you can get up to $12,000. And it's a deduction over and above your standard deduction or itemized deductions. Those are additional deductions.
And then are there any changes to the tax brackets, deductions, or credits that apply to businesses?
Usually the tax brackets apply to corporations and to individuals. So the tax brackets have not changed. They're still 10%, 12%, 22%, 24%, 36%, and 37%. So those have not changed. Just the amounts that are within those brackets have changed.
So just to transition to another scary subject within taxes, the IRS. Can you just explain what IRS representation is, who needs it, and why it's important?
So IRS representation is really important because, and this has to be done through a tax professional. Say, for example, you owe taxes, say, for example, $10,000, and you cannot find a way to pay it, and you're considered uncollectible in that you do not have enough income to pay those taxes. You need to go and prepare for an installment agreement with the IRS, and they'll need your personal financial statement to see how much income you have and how much you can pay towards the tax. Sometimes it's forgiven 100%, but some people are more liable to have an installment agreement.
Does everyone prepare a personal financial statement?
Not everyone who prepares a personal financial statement. You have to do it through a form called a 433A, and you can find that in the irs.gov, and that will help you prepare your financial statement.
So what happens when you receive a letter from the IRS?
When you receive a letter from the IRS, do not ignore it because they're deadlines. And you have to pay attention to the deadlines because if you do not, interest and penalty will accrue as of the due date of that notice. So it's important that you take the notice, give it to your tax professional, and the tax professional will help you navigate through the tax notice.
And then you mentioned about someone not being able to pay for their taxes. What options exist for someone like that?
Well, you can always go for an installment agreement because the IRS allows it. And I believe now you can do it through the irs.gov to request for an installment agreement. And another one is an offer in compromise. If you cannot pay completely your debt or you're in financial distress, you can request for an offer in compromise, which reduces your tax liability.
And then what are some common red flags that can trigger a tax audit?
So a tax audit can be triggered if you repeatedly record losses. So, for example, it's expected over a period of 5 years to have 3 years of losses. That's the IRS guideline. But if you continuously report losses, that will be highlighted. And audits are really sporadic. They're not. You cannot really tell who's going to be audited. You could have a payment history, IRS tax preparation history, but you can still be audited. The IRS uses a system where they pick out randomly taxpayers whom they can audit, and also people who are in large roles, for example, celebrities. Are usually audited, and people who are big in the news are also audited.
So when is tax software enough, and when should someone consider working with a CPA?
So I've seen situations where as an individual, whether a man or a woman, loses their spouse, and either the spouse used to control all their financial information and prepare all their taxes. So you'll be faced with situations where most of the time it's the woman in the relationship who has never prepared a tax return, and that's when you have to go to a professional to help you with preparing that tax return.
So in a world where AI is becoming more prevalent in tax planning, do you think there's ways that you will be working collaboratively with it, or will it be more people can just use AI to do their taxes?
Well, one thing you have to realize is that people have income from different sources. So sometimes AI might not identify that. And that's why you need us, and deductions. They might not get deductions that are needed because professionals, they go for continuing professional education, at least for CPAs, it's 40 hours a year and more. And they learn all these new rules and all these new ways to plan your taxes so that you pay the least amount possible of tax legally. So you still need a tax professional. Even though AI is prevalent now, you still need a tax professional to help you navigate through the tax laws.
Mm-hmm. So what is an important question that you think people don't ask their CPA but should?
They usually do not ask them what my future will look like, because they just come with income and statement from the past, income from the past, income and expenses from the past, but they do not want to project what their future will look like, especially now with people retiring, baby boomers. They need to know what their future will look like and how they're going to support their income throughout the years. And one thing I noticed is that with retirement accounts, we have what is called the pre-tax and post-tax retirement contributions. A lot of people do pre-tax contributions because at this point in time, they're earning the highest. So why should you take out the taxes at this point in time when your tax bracket is high? Why not wait until after you have retired, when you have less income, to take off your taxes? The other one is the Roth IRAs, and the Roth IRAs usually are post-tax. Those are good for you when you're retired, because you do not have to pay taxes on them, because the taxes are taken out before you put them in your retirement account.
So how can someone get in touch with you with more questions?
So to get in touch with me with more questions, you can reach me at my website, www.misikotaxservices.com, or you can email me at Chellah, Chellah, at misikotaxservices.com.
Is there anything else that you'd like to add?
I would like to add that now with the Trump accounts for $1,000 for babies who are born in 2024 and all the way through 2028 for the next 4 years will get a $1,000 Trump account, and that account will allow parents to save money for their children until they're 18, and you can only withdraw it when you're 18.
Well, thank you so much. Thank you for all of your knowledge and your 12 years of experience. It clearly shows. And thank you so much, our listener, for paying attention and listening to and educating yourself on the upcoming tax year to hopefully navigate the tax laws with more ease and feel more confident as you go into this tax season and make it stress-free for yourself. Thank you for listening to CVC Interviews, and have a great day.